and how markets trend from here on. We have someone who is qualified to do exactly that. Neelkanth Mishra, Head of Equity Strategy India at Credit Suisse, is joining us now as our market master for the day. Neelkanth, good morning, and thank you very much for joining us and dropping in the studio as well. Well, what does it look like? It's not been a very fruitful year as far as the Nifty performance is concerned, or as far as FII flows are concerned. Is there reason to believe that now they have reached value levels and 2016 will be better for the big stocks?
Not really. I think that the global linkages are the biggest concern. We are very worried about what's happening abroad. And unfortunately, the larger listed stocks are also much more linked to the world than they are to India. So 53% of BSE 100 revenues are not linked to India at all. And even the remaining 47% are our favorite banks, where because of a negative WPI, credit growth has been suffering. There is also a concern of NPAs from the metals exposure. So the BSE 100 is actually, to a large extent, not linked to India. And there are very worrying signs abroad. I mean, if you see the junk bond market, there are signs that there's liquidity stress coming up. Commodity prices, if they fall below a point, like if you see the bond yields of some large metal companies, they are almost verging on the verge, and they're signaling massive stress. And if iron ore, say, stays below 40, copper goes down even further, aluminium falls. These are risks. There are some concerns that China possibly slows down further next year. And so from a global perspective, and of course there is also the FII flows that you mentioned. I think the source of FII inflows in 2011, 12, 13, when our economy was going through a very bad phase, was the surplus savings from, say, the sovereign wealth funds. Now that oil prices are below 40, they are redeeming these investments. And the problem with these flows is also the asynchronicity. So if you have action and reaction very close, you get a causal relationship drawn, right? So oil prices fell to 40, we saw selling. The problem with this kind of selling is that it happens with a lag. So you have, oil prices falling to 40 now. Some bureaucrat in a West Asian economy will go and tell the head of the SWF, we need $15 billion more in, say, January or February. And then they send their redemption requests to all the funds, and then funds come and start selling. And here, because it's like Rahu Ketu kind of analysis, why are FII selling? Or it must be because the government did something and put a raid on someone. So people start cooking up reasons. But the real reason is that the surpluses are shifting. And they're shifting to economies which will invest through FDI and bond markets, right? So Germany, Taiwan, Japan, Korea, China. These are economies that either invest through FDI or through the bond markets, through pension and insurance funds. So equity outflows from the FIIs, I think, will persist in 2016 as well.
Okay. So you spoke about the global worries, but even locally, nothing seems to be picking up. Earnings are not improving. Rural sentiment continues to remain very low. Do you see any pickup in activity locally?
Absolutely. I think the local economy is actually doing pretty well. Okay. The point is, and so let me address both of these concerns. I hear you, and I think they're genuine concerns. But if you split the BSE 100 earnings and how they have moved over the past year, most of the cuts have happened in the global focus sectors. So you've seen metals, energy, an auto company with a large global exposure. So these are companies that have seen brutal cuts. And therefore, the BSE 100 forward integer hasn't moved at all. If you look at the farmer, the agricultural economy, actually the farmer, more than the industry, is linked to what's happening globally. So everything from milk prices to corn prices to cotton, soya, rubber, even types of wheat and rice, these are linked to what's happening globally. And that's the reason why the small part that remains of agriculture in the rural economy, I think less than a fourth of the rural economy is now agriculture, that's under severe distress. So we've seen volume declines because of the bad monsoon and the hailstorm in the Rabi season. The Rabi sowing is still rather weak. It has improved a bit, but it's still pretty weak. And so there are bad volumes and bad prices. But despite that, there are some very welcome and heartening signs in the economy. So we are seeing very robust auto sales. We are seeing very robust oil sales. The 3-month moving average on oil sales is actually the highest we've seen in a decade. Right? So these are very heartening signs. The only weak sign right now is cement, but otherwise the indicators which indicate hard activity are all flashing green in my view. And that's the reason why if you split the BSE 500 into the next 400 and the BSE 100, the BSE 100 has done very badly. The next 400 are actually up. So if you add the market cap of the next 400, they are up over the last 12 months. Partly because they haven't seen FII selling, but partly also because they're far more exposed to the domestic economy than they are exposed to the global economy.
Okay. So in that case, what kind of stocks will you play? I mean, should you not be positive on, say, NBFCs, which lend largely to these kinds of companies?
Absolutely. So, so we have been very constructive on NBFCs. There are some that are looking a bit stretched, but yes, that's one sector where I think there should be persistent growth. They're also stepping in where the banks are letting go because of the concerns around bad loans. There's also consumption, and I think in the next year, so if you recall the early part of 2015, we had seen the government go through very acute fiscal consolidation, right? A very last-minute kind of crunch on spending. And I think the bigger thing happened away from the public eye at the state government level. There was even worse consolidation forced on the state government because the center just stopped sending, they had no cash to send. Now, what we are going to see in the next 3-4 months is a very, very bad base, right? So this year, the receipts of the government, if you look at percentage, say in the first 7 months as a percentage of full year targets, we are third best in 17 years, right? So the deficit numbers, as I'm sure you're well aware, are actually quite healthy compared to where we usually are at this time of the year. And that means that the need to consolidate at that pace doesn't exist, right? And so February, March, April, May, the year-on-year numbers will look exceptionally good. From June onwards, as the pay commission hits, you will see this acts like a stimulus. I mean, of course, there is someone who's paying for it, and it could be everyone who's not in the government who actually pays for it, and then we can discuss how. But the point is that in an economy where there's a lot of slack in labor, because tier 3, tier 4 real estate markets actually are completely focused on the pay commission. So the reason why the smaller towns are seeing weak real estate markets is because the 6th pay commission effects have faded. Okay. Because if you see 50% of central government employment is actually in cities outside the top 100.
Okay.
If you add the pensioners and if you add the state government employees, which are 3 times the number, then they're almost always away from the big cities. These are railway townships, these are army cantonment towns, these are areas where you have tax administrators, land record administrators. And these economies only see big cash infusion during the pay commission.
Okay.
And and given that most government employees are in the top quarter of consumers, right? Even the bottommost will be in the top quarter of consumers, which is perhaps why you see 3 lakh applicants for 300 jobs, because it gives you a lot of security and good consumption. The incremental spend is almost always on cars and housing and jewelry and processed food.
Okay, that point is taken. So those are a couple of sectors that you're bullish on. You were making a reference to the cement space and how it hasn't recovered. That's a serious problem, right?
Yes.
Because the latest we hear is that there is even more correction in cement prices, and it's very pronounced in the northern region. You have been bullish on stocks like Ultratech Cement, etc. How much longer do you think we'll have to wait for a recovery in that space?
I think, there are 2 aspects there. The first is that there is infrastructure and there is housing. Right? And housing you can break down into urban housing and rural housing. On the infrastructure side, I think the pickup in government spending that we have seen, the downstream effects, the government starts spending, acquires land, gives away the contracts, then digging starts, and then a couple of months later, the cement demand starts to move up, right? So that activity we will see. I mean, railway station modernization projects, 400 stations, reverse Swiss auction or something, and then 15, 20 stations have been auctioned. Activity will pick up, right? So on the infrastructure side, I think the demand should start to improve in the new year. I think next year's base is actually very bad, right? So if you remember, March quarter was horrible, June was horrible as well. So we should see slightly better numbers. On the housing side, I think the rural housing, what we need for that to pick up is better agri-commodity prices. So if, say, cotton prices were to improve from here, if sugar prices continue to improve from here, if you see soya, rubber, corn, wheat prices, and unlike, say, what's happening in iron ore or copper, where when I can try to convince you that this will last for 5 years, on agri-commodities that's not going to happen. That's unlikely to happen. So it's very clear that I think in the new year, the rural agri-commodity price improvement should provide some more comfort to the farmer, and I think that's very important. The urban side, I mean, we all keep obsessing about Lower Parel and Gurgaon real estate, but that's not very big consumer of cement, right? But it is the cities outside the top 100 where a large part of the population lives. That's where you would, when the real estate market picks up, and that could be second half next year.
So, and what stocks then? I mean, normally the FMCG stocks will benefit, but they're all above 40 times already.
No. They're 27, 28, 31, 32. Well, there's several. So, so if you look across
so
the market,
FMCG would be your pick, is it?
FMCG and even discretionary. So because eventually it is new home construction. I mean, there is switchgear, the electrical appliances. I mean, all of those things start to benefit. While we not particularly constructive on jewelry because of what's happening to gold, but if you see the consumption behavior as you move from the 11th to the 12th fractile, gold purchases go up very sharply.
Okay.
So those are things that I can actually benefit as well. Entertainment. So what you find is that the spend on cable TV picks up very sharply.
Okay, that's an interesting set of stocks that you are pointing to, even if you're not mentioning. Neelkanth, you're one of the few people who are telling us that 2016 is going to be very positive, subaltern, bottom up. That itself is a positive. Thank you very much for joining us with all your views.
Thank you.
Well, that's the word coming in, very positive on the rural economy and on mid-tier Indian cities in 2016.